So tonight's webinar once again is entitled How to Scan for Stocks. What we're going to show you is how to use our stock scanner or whatever stock scanner you choose to use, and also go through some sort of proven screens based on the investment criteria of other gurus. So we'll go ahead and start off here. In the top of the page, you're going to see one of the headings is Screeners. This is where you're going to find everything you need to screen for stocks. So it's going to be access to the AllinOne Screener, the different guru scans, and within that you see this drop-down menu. And I'll take you to the AllinOne Screener at first. Just kind of give you a quick rundown here. There's obviously several tabs across the top you can use based on various investment metrics. So fundamental stuff is going to be PE ratio, price to book, etc. That's on valuation ratio, profitability measures as far as what are they growing, what are earnings looking like, what is it growing at, what are the historical valuations. We also do it in valuation ranks. You can compare it against the industry. So if you want to find the top 90th percentile earners or low debt companies based on their field. You can do it based on price if you want to find stocks that are halfway off their 5-year high or trading near 52-week lows, anything like that. We can scan for dividends, action by different gurus, and also insider transactions. So we'll go ahead and kind of get started through a few of these. To get started with this, if you're new to screeners, some of the best ones we have available here are already set up for you to kind of get some ideas in front of you. And you see this in the Guru Screens drop down. We've got the Ben Graham Lost Formula, the Buffett Munger Screener, the top 10 aggregated hedge fund screens. What that does is show you the portfolios of the 10 largest hedge funds aggregated together. What are the stocks they are holding the most of? There are 52-week high and low screens, low price to book. Well, let's kind of play with some of these. The first one, now this one I really like for longer term holds. This is the undervalued predictable screens. And what this is, Charlie did a great write-up on it a couple of years ago, and he did a very in-depth study over about a 10-year period in the stock market where he looked at what caused stocks to outperform, and can you categorize stocks in a way that you can not only limit downside risk but also still achieve market-beating returns. And he did so studying the predictability. And what he looked at is companies that have over the last 10 years are very consistent with their revenues and with their earnings and with the EBITDA, and also never had losing years. And so from that came the predictability ranking. And that's when you look at each of these stocks. It starts at the top. It's a business predictability ranking, and so the higher the ranking, obviously, the better. So any stock that's scanning, I'd say 3 stars or higher, is a pretty consistent earning company, right? They're one that hasn't lost any money the last 5-10 years. They're growing at a pretty smooth trajectory. And so what this screen does is find those predictable companies that are also undervalued based on their discount cash flow valuation. So it's going to show you based on the discount earning and discount cash flow, as you can see here, and shows you at what percentage of a discount they are over or undervalued based on that. So it's a really nice little screener to use if you're looking for, I would say, higher quality companies. Now, some of these are going to be premium features, some of them are not. The AllinOne Screener, some of the functionality is fine for basic and standard members. Some of it you have to be a premium member to access. Now, some of the others in here, the Buffett Munger Screener, for instance, is one that scans based on the criteria that Warren Buffett and Charlie Munger have laid out many times over what they look for in a company. And so it's going to kind of highlight some of these. But really, if you get into screeners a lot, you're going to want to start playing with them yourself. And so if we start here at the AllinOne Screener, again, you can find screeners on finviz.com and some other sites. They're just not as in-depth as this one. It's more based on trying to find technical indications, which I don't know about you, but I've never had any success with, where this is really an in-depth fundamental screener. So over here on the left side, what you'll see to kind of get started are breakdowns for a couple of screens you can put together yourself. Now, if you ever heard of Walter Schloss, he was a guy who learned from Graham just with Buffett, and Buffett once called him a super investor. He's a guy that came out and said really he didn't care what the company's doing. Okay, so he doesn't do a whole lot of in-depth research, doesn't care what kind of firm it is, what industry they're in. All he looks for is cheap stocks. and he had a fantastic track record, 21% a year, averaged over 50 years doing this, and this is what he said he looked for. And Charlie's done a little write-up here. He could show you how to build this screener, and so I think it's a good example to show you how to use it and how to go about applying metrics you wanted companies to buy to the screener. So the first thing he said, he wants cheap stocks. Looks to buy them around book value, little to no debt, and stocks trading near their lows. Okay, so little to no debt. A good way to scan for this is interest coverage. Okay, so interest coverage says, you know, based on their total debt, what is their interest payment each quarter or each year, and how many times that do they earn each year? Okay, so you know, or if their interest coverage is a 2, that means half their money is going to cover the interest payments. If their interest coverage is a 20, it's like 5%. We're less worried. So we want interest coverage of 10 or greater. Okay, so we're going to first go to that here on the screener, and I believe it is on the fundamental tab, which it is, and right here you're going to see interest coverage. And if you don't know what any of these are, just click the heading and a little box will pop up. Mine's a little bit slow right now because I'm broadcasting and the connection is a little bit slow, but it'll give you an explanation, as you can see here, operating income divided by interest expense. So once at least 10 times. So these operate on 2 drop downs. One is a minimum and one is a maximum. So you can choose a range, or you can do just one. We're going to put 10 as our minimum. So it's going to be 10 times or greater for interest coverage. Okay, we see we're instantly dropped here to 509 companies that meet that criteria. And if you want to go, you know, depending on what country you're in, I'm going to obviously select the U.S. here to filter down to just U.S. stocks. And there's also a box that says OTC stocks. I'm going to exclude over-the-counter stocks. Now it looks like I checked the wrong box here. I checked the current ratio. My apologies. It should be interest coverage, which is here. Sorry about that. So yeah, interest coverage 10 or greater. All right. And the other metrics he looked for, Altman Z-score of greater than 2.99, so essentially 3 or better. That's on the fundamental tab as well, so we'll put that in there as a minimum. Bring us further from 867 down to 661. And wanted price to book less than 1. So we wanted cheap stocks, right? Stocks trading at a discount to their book value. So price to tangible book is going to be, I think it's here on valuation ratios, and it is. So here's price to tangible book. So we want a maximum, so we'll check the right side, max 1, want it less than 1. Okay, now we're already down to 82 securities. And then finally, he wanted stocks trading near their 3-year lows. So you can categorize near any way you want. Charlie said here, you know, maximum 25% above the 3-year low. So if you click on, I believe, is it price? Historical valuation, sorry. So we'll go to historical valuation. We can set the max percentage above the 3-year lows. You can have it really, really close or anywhere in between. So we're going to say max 25% above its 3-year low. And so we've whittled down here to a list of 26 securities. We've greatly cut our homework down. We've just got a handful of stocks to look at. Another thing you're going to see a lot of, you're going to see some of these funds and financial companies. Now, as value investors, financials are really, really tough to do. They're just tougher to price and to analyze because their balance sheets can be a black hole or they can be a hidden asset. It's really complex. So one thing I like to do is just take them out of my scans. All right. So you see here you got an option for industry, and you can choose what industries you want to include in your scan. So instead of going one by one through all these, what I'll do is just select all of them and then scroll back down to financial services and just remove those. Okay, so here's the financial services tab. We'll just take that out. It's asset management, banks, brokerage houses, insurance, credit services. Take all those out. And then now we're down to a nice tidy list of 9 stocks. Okay, Universal Security, Friedman Industries, Timberline Resources. And so from here, now you've got a nice concentration of stocks to look for if you're trying to buy cheap stocks like Walter Schloss did. Okay, if you want to focus on that area of the industry. Now, most successful stock pickers that I've known, Every once in a while there's a Warren Buffett or a Peter Lynch or just an absolute legend out there. For the most part, people specialize in one area of the market. Okay, maybe you're a growth stock guy and you just want to find that needle in the haystack, that the next eBay or the next Google. Maybe you're a Walter Schloss type guy, just wants them trading deep, just cheap stocks, way oversold. You don't care if they grow anymore. You just think you can get the assets for less than they're worth. Maybe you're a turnaround type person who likes to dive and find the Radio Shacks or the beaten up stocks that you think are going to turn back around. So there's lots of different avenues you can go with this. You don't have to specialize in everything, but luckily this screener allows you to do pretty much any of this. So there's a quick scan here, and again you can go back and find this. I'm not hiding anything. If you go to the AllinOne Screener page, these tutorials are there. Okay, so you see them right here. That's the Walter Schloss cheap stock screen. There's some screens for Ben Graham's lost formula, Peter Lynch buys, all kinds of options you can use there. And the other thing I want to show you, once you've got it here, if there's certain things you want to focus on. Okay, so if you're looking for trying to get a discounted book, you're looking for this and that, you can customize the way you view these. So I'm noticing immediately that none of these show me the PE ratio, which is important to me. All right, so I can click on Customized here and choose how we want to view this information. So if we click Customize View over here on the left side, we can choose the metrics we want to view. So we can put price to earnings, price to book on here, 52-week change, whatever we want to do. And then just save this view. And now we're seeing the same stocks based on the metrics we wanted to look at. You can also look at it on a chart view and see this as several of the Peter Lynch charts that we have in the interactive chart feature. There's lots of ways to view this information. You can immediately add these stocks to your digital portfolio where they'll be tracked. You can put in prices and kind of check your strategy even if you don't want to put real money toward it yet. And then these are also the other views. If you're a growth guy or dividend or valuation model, there's different ways to view those. So a lot of cool stuff in there. Jim, why is IBM on the list? Jim, IBM is just trading. It's trading at a discount, a tangible book, and it's trading within 25% of its 3-year low. So it's on the list. You'll see. I think Buffett does Buffett have a position in IBM? Yeah, Buffett's got a pretty sizable position in IBM as well. It's probably no surprise that it's just popping up on these type of cheap stock screeners. So that's cheap. So how many of you are dividend investors? Any of you guys big just chasing yield, dividend investors looking for something that you don't have to pay an arm and a leg for? You can scan for this as well. Scott, can you show it add to the portfolio? Sure. Yeah, if you want to add to the portfolio, there's a button down here in the bottom left of the screen that just says add to my portfolio. And when you click that, it's going to immediately put these tickers down here in the bottom. And you can either add them into a portfolio you've already got or create a new portfolio. I'll just go ahead and create a new portfolio. And then you just name it. So these are maybe Schloss stocks. And you can also check if you want to get notifications on these via email if anything changes or a report comes out. We'll just go ahead and create that portfolio. And if you haven't messed with my portfolio part, this is something I really didn't know much about until I came to work with Charlie, but the cool thing about this, the My Portfolio will really, it'll let you track the performance if you're not, so say you've got money in a certain type of fund, and you say, I kind of want to try, deep discount stocks, I want to try some growth stocks, but I'm not sure if I want to put, my hard-earned equity towards it. You can do this as sort of a virtual account. And so if you want to buy all these today at current prices, say you want to pick up 1,000 shares of this, you want to pick up 500 shares of this, whatever that may be, you can save them and it's going to automatically track the value as well as percentage and dollar gains. The other cool thing is if you say, oh, I bought this thing a month ago, or I would have bought it a month ago, I forgot to add it, you just come in here and click the date. Click the date when you bought this stock, and it will immediately give you the price where it closed on that day. And if you think, actually I bought it, 324 or 320 or whatever, you can save it there, and it immediately tracks the percentage gain in that stock as well as your dollar gain. And if you treat this as a real portfolio and say, okay, I'm going to use a portfolio of $100,000 and allocate accordingly, and do it for 3 months, 6 months, a year, whatever, you can really track how your shares are performing and how those stocks are coming to reach value. It's got some other things. I mean, showing you the 10-year PE range, which is nice, and where the stock has moved, and a lot of other things here. Once again, you can change this view, customize it as much as you want, view this as charts. There's lots of different ways to do this. But it's really neat to have these portfolios. And you see up here at the top, they're all tracked, so you can kind of switch back and forth between them. Laurie, good question. No, percentage gain does not include reinvested dividends. It's the only thing you'd have to track is dividends. So other screens here, we talked about like if you're a big dividend guy. Okay, so some of these dividends. Once again, I'll just select the U.S. as a company or as a country, and I'll go ahead and exclude over-the-counter stocks. Just a little bit risky for my blood. I'm going to go ahead and take those out. And there's a dividends tab here at the top. So the way a lot of people look at dividends, we want the most yield we can get, right? I mean, the average dividend yield for the S&P 500 is around 1.5% right now. It's, really, really low compared to historical ratios. So say you want, at least a 3% yield. You can, find stocks meeting that criteria. Maybe you want to be sure they're going to stay for a while, so you want at least 10 years of dividend payments. You can scan for that. The biggest thing is a dividend growth rate, right? So the idea behind dividends is not you put $100 in it now and you'll make $3 a year from here to eternity. You want a company that's growing its dividends with the company. So as they earn more, you make more, and you continue to grow the dividends. So that's where dividends really become powerful, is if you put $100 towards it needing $3 a year now, 10, 15 years from now, you want to be getting $10 to $15, so you're getting 10 to 15% yield on your original cost. And so if you look for growth rates, maybe you want them growing at least 10% a year going forward. Another thing we like to look at, the payout ratio. That's the percentage of the company's earnings they're paying out as dividends. And if a company's payout ratio is too high, it kind of spell a risky situation, right? So if they're paying out 80% of their profits in dividends, what happens when their sales miss by 20 or 30%? And now they're having to either borrow money or shrink dividends. It's a situation we don't want to get into. So maybe the payout ratio, less than, say, 60%. It's not going to haircut you too bad, but most companies pay a lot lower than that. So you just want to be sure they're not, that dividend yield is not dependent on almost every dime they make. So this quickly gives you a list of companies. If you want to find really high quality companies as well, we can go and scan the predictability here. So maybe we want 3 stars or better out of these companies. And we've immediately got a very short list here of quality companies paying at least 3% that have grown at least 10% a year, that have been paying dividends for the last decade. We're looking at Lockheed Martin, CPSI. My brother actually works for them. McDonald's, Alliance Resource, etc. Richard, can you keep a cash position portfolio? Yeah, absolutely, Richard. I mean, you're just going to have to track it hypothetically, right? So if you're giving yourself a certain amount, or you can do like a money market ticker, something like that as well. Okay, so Anand asks, how do you go from a screen to an article explaining the screen? For example, how'd you get the Walter Schloss article? So there's not articles in all of them, but like when you go to the AllinOne Screener page, okay, right here there are a handful of these write-ups that have been done by us, and this is them. And each one of them just takes you to an article on the website that has the details of the Schloss, the high dividend, Ben Graham's magic formula, Peter Lynch screen, etc. And just clicking on those will take you to that tab. Now, as far as the screeners that are pre-built in here, like if we go to the Ben Graham net screener, for instance, it's not going to give you as in-depth of an explanation on that screener. But all the fundamentals are built in based on that. Now you can click. Oh, so here's the explanation. Excuse me. It's not as in depth as the others, sort of breaking it down. But if you click Show Hide here, it's going to give you an explanation. Ben Graham, what he looked for, what the metrics are we're scanning for, so you can kind of understand what's behind this. And you should see that in pretty much any of these. If you go down here to the Buffett Munger, You can see this as well at the top. Just click to show hide, which shows you the definition. We've kind of got it hidden so you can immediately see the stocks if you're already familiar with it. But if not, just click there and it's going to show you how this breaks down. And on the tracked portfolios, we've got it's got showing you a history. And we don't back test this, okay? So it's not if and what. This is since we made it an active live screener, what the performance has been. That's why it goes back here to early 2009. But you can see it kind of how it's been beating the market. What, 134% compared to 103%. Okay, Greg's asking a few questions. I'll let Charlie touch on those in a minute, Greg. Greg's asking about custom metrics available, dividend yield plus growth rate, anything like that. Okay, Charlie's saying one of the fundamentals we have is a yield on cost screen, and I believe that's in the dividend tab. Okay, so that's kind of interesting. So I didn't even know this. What Charlie's telling me, we did the dividend scan earlier. You can actually scan yield on cost, which is going to take into account the dividend continuing to grow at the rate it has been. So you get a kind of better idea of what yield you can hope to achieve going forward. Scott, how do you see the fundamentals built in? So in any of those screeners, the fundamentals built into them are, let's see, so let's look at like low price to sales companies. Usually there's links to that, like this one, companies low price to sales, etc. So there's kind of write-up showing you what's built into these screeners. But for the most part, I mean, for most of you, when you get into stock screening, there's certain things you're looking for. Maybe you're more of a growth guy. Maybe you're more of a person who likes to invest in dividends. Maybe you're someone who wants, deep discounts, so trading at like half their book value. But all that's available within here to begin scanning for stocks. So another legendary investor, Peter Lynch, is one I think is famous for what he called 5 baggers and 10 baggers, and we get into his valuations. We can kind of quickly build a screen based on what he looked for. Right now, he was all about the earnings. Okay, the only real fundamental stuff he looked for, he wanted debt to equity less than about 40%. So we max that out at say 40%. But he was a growth guy. Okay, he wanted the stocks that are growing year over year and trading at a reasonable multiple. So he would scan for stocks growing their earnings, what he called fast growers. He'd look for 20 to 30% annualized growth. Anything over 35 or 40% he was skeptical of. Anything under 20 he wasn't really concerned with paying up for. So you can scan for those companies growing their earnings at 20 to 30% and quickly dwindle you down a list. You can go to the valuation if you want to find them trading at an earnings multiple less than their growth rate. So you want to say maybe a PEG max out at 1. And you can quickly begin to find companies that are meeting his fundamental criteria. So looking for stocks that are fast growers, but also not trading at earnings multiples above that growth rate. And kind of dig into some of these. We've quickly dwindled it now to 25 stocks. I mean, the beauty of an overpriced market is you don't have to do as much homework because there's not as many values out there. So this is a nice quick list of companies that would meet some of his basic fundamental criteria. And then once again, if you want to find the more quality stocks, you can get the predictability 2 stars or better and quickly dwindle that down. And this is the predictability scan is probably one of the best proprietary features here, just because you can immediately cut out the stocks that are make money one year, lose money the next. You can really cut down to the higher quality equities. Greg, any metrics include a flush-out candidate for long-term earnings lower as defined by Heidman? I'm not sure. I'll let Charlie touch on that when he comes on in a minute. We do have Charlie Tian here, guys. He is the creator of Guru Focus and the president. He's going to kind of answer some of the more technical questions for you guys that are the data that really understand the information behind his data. Now, with any of these scans, you can also scan other countries. So I don't know how many of you guys are global members. we're aware the U.S. is in a bit of an overvalued state. You can find that at any time, whether you're a free or premium member, hovering over the market tab and clicking the global market valuation. And it's going to quickly show you some of the most widely used valuation metrics for the overall market. Okay, and some of the biggest are market cap to GDP. It's going to show you, here's a ratio of that. Let me see, there's another tab that's got this even easier for you. Here quickly shows you the projected annual return of various markets. So this is all based on, if you're not familiar with it, I'd encourage you to read this. If you click on market cap to GDP valuations, available for free and premium. But this is an indicator Buffett called probably the best metric on where valuations stand at any given time. And so what it looks at is the gross domestic product, just the total goods and services being produced by the U.S. in a year, versus the total market cap, so the price of every stock in the U.S. market. And what he found is the higher that ratio, the more overvalued the markets are. And you can see that chart right here in the bottom right. And I'll actually make it bigger for you. I'll pull up our interactive chart. I just pulled up Google, but I'm going to go down here and use the economic indicators. And here's that ratio. So we use the Wilshire 5000 for total market cap and gross national product instead of GDP. They're about the same. But you see over 1 is 100%. And Buffett really likes it when it's below 80. The lower the better, because you're getting more bang for your buck. The higher, the more risky it becomes. And you see here, we are at the highest it's ever, well, it's been in at least the last 30 years, 40 years, with the exception of the 1999 tech bubble that pushed us all the way up to 1.4. So we're at about 1.16 right now, or 116%. So getting very overvalued, getting to be a risky situation. So when you scroll back here, what this ratio represents is what the forward rate of return looks like based on that ratio. They've studied this, over a century of market data, and when we look at this list of companies, we're quickly seeing that the U.S.'s forward rate of return based on the market valuation is about 1.8%. Now remember, dividends are averaging about 2%. You're actually looking at negative returns. Does that mean the market can't go higher? No, but it means that odds are, if you buy a basket of stocks here, just buy the market, hold it for 10 years, you're probably not going to see a lot of gain. But we look at we look at some of the larger return numbers here are Singapore, Australia, a lot of Italy, a lot of Europe in here, the Netherlands, Korea. So a lot of investors today are kind of shifting their focus toward global markets because it's such a global economy today. And so with the all-in-one screener, the cool thing is we can scan for the exact same metrics, the same Schloss formula or high dividend or Buffett or Graham or Lynch, and just check the other countries to include the ones. You can even take off the U.S. You say, I want to look in Europe and the U.K., and it's going to give you a much larger basket of stocks to scan for, and probably going to allow you to find better opportunities. So if you're not a global member, you can add that on. I think it's priced per country or per region. If you're 6 months into your subscription, you add one, it's prorated out at all, so you can cancel, you can add them and remove them at any time. So if you're interested in that, I just want you to know it's an option. So let me look back at your questions here. Boyd asks, how's the PEG determined? Where you're getting information for growth? So the growth is looking at EBITDA growth on our PEG ratio. So it's the PE ratio over the 5-year average of EBITDA growth. We found out to be a little bit more accurate than earnings growth because it kind of smooths that out. And do we offer any analyst estimates for screening for future growth in earnings per share? I don't believe there's analyst estimates for growth. No, I mean if analysts have proven anything, it's that they are wrong as much as they are right. If they were so bright, then mutual funds would not consistently underperform the market. So we don't tend to put a lot of weight on analyst opinions, so they're not built into the screener. Ruben, I think your question might have gotten lost. Do you mind retyping it? Cheyenne, the projections for how many years? Well, it's just for, what is the projection? How many years going forward based on? For 7 year. Okay, so it's a 7-year projection rate. Good question, Cheyenne. 7-year projection rate for returns. So some of these other scans, the ones we've been liking recently, low price to book has been really outperforming what we've seen as far as price to sales and price to earnings. And when you're looking at low price to book companies, this is really cool because what it does, and again, you can click this to find an explanation of that, and you can see the outperformance of this model portfolio versus the market. But a lot of screeners will allow you to say, I'm going to look for a price to book of less than 1.5 or less than 1 or whatever. But what this one does is actually scan versus that company's historic price to book ratio. So whereas a gold mining company may generally trade at a multiple of book value very different than a Gap or a retailer type business, this allows you to scan for low price to book relative to that specific company's history. And so I think it's powerful in that, one, it's finding high quality companies. You see the predictability ranks here. And second, just finding them relatively low to what they normally trade for. Okay, so if you're trying to buy Coca-Cola at 8 times earnings, it's probably not going to happen, and I don't think it's happened in decades. But if you're trying to buy it at a low price to book multiple, you may only want to buy companies trading at twice book. Well, Coca-Cola over the last 10 years has never traded below 4 times book value. And so here we have an opportunity to buy it at 5, which is pretty close to that low. So again, if you're into the mega cap stocks, the larger, safer, more blue chip type companies, these screens will allow you to kind of pull through those and find those high quality companies trading at low valuations relative to themselves. And so you can do the exact same thing with price to sales. Does the same thing. We've just been really liking the price to book scan. Has been performing extremely well. I think when the market was flat, we looked at it about a week ago, the S&P was about flat for the year. This portfolio was up maybe 7% or so, I think. Let me see if I can pull up the performance of this thing. So here it is. Yeah, there it is on the right. So the market's kind of popped the last couple of days, if you guys have seen, but it's still only up 0.5% this year. And these low price to book companies are up 7% already in a flat market. And so price to sales doing doing well as well. But you can quickly go through here. So if you want to use some of our strategies that are built in here, you can say, look, I'm not going to throw money away blindly. I want to see what it's done. This is track performance of these. It's not back tested. It's live performance since we enacted these various screens. And so the low price to book, it barely was outperformed in 11, beat it in 12, beat it last year, is slaughtering it this year, beat it in 2010. So it's a very basic filter that looks for quality companies trading at relatively low levels of their book value. And the same thing with price to sales, same thing with undervalued predictables, the Buffett-Munger screener. But they are definitely all outperforming the S&P 500. So if you're looking for something quick and easy, not a bad way to do it. Okay, where do you get your data from? How accurate is it? Yeah, the data comes direct from Morningstar, so it's extremely accurate. If there's an issue with the data, it'd be Morningstar's issue, but it's a direct pipe from Morningstar. Akshat, excuse me. How does the red rectangle around the predictability represent? So good question again. The red box around the predictability means that the predictability might be in danger of slipping down. So you see there in parentheses it says on watch. It's 4-star. It's just knowing you. It's letting you know it's getting near a threshold where it may kick down to 3.5 stars. Greg, how'd you get to that screen? If you hover over screeners at the top and then get to all model portfolios, that's the model portfolios we've got tracked here. You can. That's not the right one. Hold on, I'm losing my own screen here. Performances, sorry. It's under performances. This shows you the portfolios. This is a quick rundown of performance. Just clicking performances up here. Clicking all model portfolios is going to show you a little more in detail breakdown of these. It's possible to create a list of companies sorted by DCF. Yeah, Rube, I believe you can in the undervalued section. So I showed you the screener for the undervalued predictables. Excuse me, I clicked the wrong thing here. There it is, undervalued predictable. here you see it says discount cash flow. There's two things here it's showing you, and it's going to be a current price to stock, what discount cash flow values it at, and what percentage of a discount you're getting. So if you click this discount heading right here, it will sort those by the greatest discount. I believe it's already done so by default. But here it is. So it's showing you those trading at the greatest discount to discount cash flow, and you're immediately seeing this column of their discount cash flow features. And I apologize if I've skipped your question, guys. I got a lot coming in. I'm trying to get to all of you. I promise we'll answer all your questions. Let me look at a couple others we had here. Ron, these companies, yeah, bought once a year at a certain time, so it's rebalanced on an annual basis. Those portfolios we showed you. I didn't see that. The default discount rate Santiago uses 12%. Lawyer, is there a way to compare performance of these screens over maybe the last 5 years, some of different start years? Yeah, so like I said, we're not using back-tested data. So again, they're all from the day they went live. So that's why some of them don't have 2009 data. So you may want to just look at, I mean, again, there's only 5 years of data, so you can kind of quickly look and see if they're consistently matching or beating the market, or if they're underperforming it. Shot. Yeah, so for the Buffett Munger screener, she's asking what the turnover rate's like. Yeah, we're choosing the top 25 stocks from that screener based on the rankings, and then it's only rebalanced once a year. So like the first of the year, it takes the top 25, and the performance is what it did from the first of the year to the end of the year, and the start of the second year, it's the top 25 once again. So it's like you sold everything and got 25 brand new stocks. Okay, I see your question, Scott. Scott's asking, Charlie, on the Buffett Munger screener, do you give the exact fundamentals you're scanning for, or is that a proprietary thing? Okay, yeah, so the exact formulas on these, the tracked value strategies we've got here are actually fundamental, or proprietary scans. So you have access to them. You can access them live as often as you want to, but the exact formula is not shared. Now, anything else, we give you some write-ups like I showed you on a lot of these other gurus who've shown what their metrics are and kind of what they look for. But these ones you're looking at right here, actually the precise formula is not shared. Now, it doesn't take a whole lot of work. I mean, if you're a student of the markets and you've studied Graham or you've studied Schloss or Buffett or any of these other guys, it's not really hard to know what these guys generally look for, what kind of stocks they're after, what kind of growth they want. You can do plenty of research here on the site and find that out and build your own screens from it. Andrew, the screeners do not account for dividends, so it's a good question, but they do not account for dividends. So for the most part, it's not going to be a big issue, especially when most companies are averaging about 2% right now. I would tend to say the dividends actually help our companies because we're looking at high-quality, predictable companies, and these tend to be the larger, more established firms who have a longer track record of paying dividends and increasing dividends. So I would think the dividend return from these portfolios would exceed that of the average for the S&P 500, but they are not included. We do not scan for stocks in Africa. I don't believe we have any access to those markets. Caesar, all these features of the screeners only available for the premium members versus free. Well, let me see. I'll log out. And we'll go to the all-in-one screener. I think a lot of this is going to be premium only. Let's see. Yeah, so a lot of the all-in-one screener is going to be premium only. I mean, I think it's worth more than its weight. I mean, Guru Focus membership's only like $2.99 a year. mean, if we can't save or make you another $300 over the course of the year in your portfolio, I would be extremely surprised. Santiago, in the default screeners, can you exclude sectors, in other words, financials? Yeah, absolutely. So what you do, if you go to, say, the Ben Graham Net screener, here a drop down is sectors. Oh, you can't exclude. Okay, so you'd have to kind of do them individually. You can't select multiple of them here, but you can just choose the sectors you want to see with these. You can exclude the OTC stocks. You can do the same predictability scans that you want, 3 stars or higher. The Ben Graham formula, you're not going to get any stars since he's looking for just deep discount stuff. But you can scan for, different market caps in different countries and different sectors as well. And once again, I mean, you can choose different countries. See, we had 23 stocks in the U.S., but you look at Canada, there's 242 of them meeting this criteria. All right, in Europe there's 135. So it just opens up a wide array of new investment possibilities and essentially multiplies your opportunities in the market. And most brokerages out there will let you do international stocks. Do a quick scan and just Google it, but most of them should let you. All right, so that's kind of the basics of screeners and how to use them. Any questions about some of this, the different screens we've got, or if you've got certain criteria you want to scan for, we can kind of walk through how to do that. You want to have any questions about this? I mean, obviously all the screens you can do, you can download the list, you can create online portfolios, you can download aggregated data on them, you can save any of your screens. So if you set one up and you scan for a handful of variables, all you've got to do is come down here where it says Save Screen and just put a name in there that you want to name this, and then anytime you come back here up in the top where it says User Defined Screens, you can have a drop down of all yours, so you don't have to rebuild them every time. So you can have a dividend scan, a low price to book scan, you can have a growth stock scan, you can have all these and they'll just immediately be able to access them. Rob, do you use different growth rates for DCF calculations? Yeah, so for the discount cash flow calculation, the growth rate is always going to be the 5-year EBITDA. Is that right? Yeah. Yeah, the 5-year EBITDA growth rates for that company. So we don't use the same one. I mean, we use a discount terminal rate of 4% for years 11 through 20, but it's always the previous 5-year EBITDA growth rate. Amy, we'll send a recording of this out. So, Stuart, are you going to review with us today the best way to use the Gurus tab? We can. We did this in a previous webinar. We can do it next week. It just takes a while to do so as far as... oh, you mean the tab on the screener. Sure. I'm sorry. Absolutely. So, the Gurus tab, what this allows you to do is if you've got some money managers that you want to follow and see what they've been doing, this will allow you to find stocks that have been bought or sold or held by these guys and women over however much time. So for instance, if you've got a handful of gurus you want to watch, you can select them through this list, which could take you a while. If you've got a saved list of gurus, you just click My Gurus and it automatically saves those. And you can scan for buying and selling action. So for instance, if we want at least one of our guys has bought one of these stocks in the last 14 days I don't have very many selected. I can pick some more here and add them to the list. So we'll get some more names. Let's see, add Smith in there, Evan Grantham. But what this is going to do is show you kind of as soon as you can get this information, picks that have been made. Okay, so this is of the guys we're tracking. These are the buys that have happened in the past 14 days that have been reported. If we want to look for ones that have sold, or any of our guys sold positions, or the ones that I own that I want to see if they've sold, you can scan for that as well to find sell actions. You can, if you're just looking for new stocks, get a hold of based on the gurus you're tracking. Say, okay, I want to see what a lot of these gurus, these fund managers are holding. So I want to see at least 5 of them holding the stock. Okay, and we got a big list. We're going to say, I want one of the ones at least 20 of these guys are holding. And here we quickly get down to Microsoft, Oracle, and Wells Fargo. You can look at the weighting as far as the percentage of their portfolio, right? So if these guys are holding 200 stocks or 300 stocks, and this one is 0.05% of their portfolio, it's obviously not on the top of their hit list, right? But if it's 10% of their portfolio, it's much more significant, right? It's one they believe in a lot more. So this will show you the weighting and filter it down to stocks being held, large quantities in portfolios. And then you can also select by how much you bought recently. Okay, so if you want to find, let's say, you want something your guys have bought, and we'll just say the last 3 months, all right? And we don't even need to filter by Guru's holding. And let's say we want to make sure it's a new position. They just bought a big chunk, all right? So impact of the Guru's portfolio due to the trade. Let's say this took up at least 5% of their portfolio. They just took a big position in this in the last 3 months, and we're quickly seeing what those are. Dow Chemical, Johnson & Johnson, Overstock. So we can click on these and find the Guru trades to see who exactly bought them, but it's going to show you sizable positions that were taken. And the other thing you can do is look at the price change since they bought or sold. Now, we've got a screener built in called Guru Bargains. You can find stocks that have been bought by the people you're tracking that are now trading at a price lower than that, so you can get a better price than they did. Or you can just say, you want to be sure it hasn't gone up more than 10% from where they bought it. Or click 0%, be sure it's lower than where they bought it. And we see those stocks. Maybe we want to see ones they bought, let's see, maybe at least 5 of them holding. And we want to see stocks that have really gotten a hit after they were bought. So here's stocks they bought that are down. Let me change this. That are down at least 30% from where they bought them. No, that should be the max. I'm sorry. I had it right the first time. I'm making myself crazy. Yeah, so the max they've gone up is negative 30%. So these are stocks they've lost money on. You can now get at a price much lower than their average fill. Yeah, and so you can also use, there's also global gurus that's going to be people in different countries buying stock that are managing money, or local managers that invest abroad. So you see when I clicked my global gurus, it immediately selected the fund managers on here that are investing overseas. And so that's going to immediately show you, what the opportunities are. And then, of course, if we click these other countries, we're getting stocks they bought in foreign markets. And it's, again, opening us up where we had 1, which is MasterCard. Now we've got 5. If we click Asia and Oceania, we'll probably get a couple more. Nope, just still 5. But it's really opening up your possibilities as an investor. Santiago, we don't really track. It's not going to show you a lot of shorts. We track like 1 or 2 people's shorts, but for the most part, no, because it's harder to track. They'll often use synthetics where they do that through options or different investment contracts. We don't generally track their shorting activity. There is some for the global gurus, but not all of them. You can't track everyone's shorts. No. Scott, question. IPAR went from DCF of $112 to $30 in a matter of a few days. Why would that happen? So, Scott, odds are they announced earnings, which changed that. We'll take a look at your stock really quickly before I turn it over to Charlie. So this is Enter Perfumes, and it's seeing a value of 30. You're saying it was 120 before. So here's what I'm guessing. I'm guessing this earnings per share figure dropped a lot. Now, the earnings per share that it uses in the calculation, it always starts at the last annual earnings per share. So if a new report came out that shrank that, which I'm guessing it did. Yeah, so here's the difference, Scott. Here's the earnings per share of this company. And again, it uses the last annual data. So as of 12, they made $4.26, which is kind of an outlier year. And then once this report came showing they made $1.27, it now started at that figure, which is 60% lower, and drastically affected discount cash flow valuation. So that's why you're seeing that. So let me turn it over to Charlie. He's going to answer, again, he is the architect of this website, so if you guys have more technical questions, I'd be glad to answer them, and then we'll finish up the evening.
Thank you, everyone. This is Charlie. Very glad to have you here. For the new premium newsletter, it's not included in the membership currently, at least. We put lots of efforts inside, and 3 of us worked on it. I will put real money in it, and here I want to talk a little bit more about the predictability of the business. In 2008, we started some research on the business quality. We found that the companies with more predictable earnings and the revenue growth tend to have less chance of getting bankrupt, and over long term, their stock performance as a group outperformed market by wide margins. We did lots of research, and we wrote research papers, and they're linked on the home page. At here, bottom here, so I group focus tutorials, what worked in market, part 1, part 2, part 3. I encourage you to read this, and so that you understand more about how our strategy works and why they outperform the market. For every stock, we tend to do a predictability rank. For instance, here, the 5 stars, the stars you see here are the rank of the predictability. Whenever you have questions, please always go to our tutorials. It's linked under home tab here in the manual. Go to our tutorials, and we have lots of stuff here. When you have a question about something, you just tap in the search box. It will list everything related to it. As a matter of fact, the recording of this webinar will also be displayed here. You can watch it later if you missed part of it. And all our screeners here, like the undervalued predictable companies, our Buffy Munger screener, and also the historical low PS companies and historical low PB companies. They are all based on they're all filtered for the predictable companies only, and they work for not only a US market, it also work for European market and Asian market. For Asian market and the European market, we have similar coverage as the US market, and also similar every tool we have, such as DCF calculator, the 10-year financial page, the interactive chart page, will also work as well for the European market and Asian market. I will be glad to answer your questions. Yeah, Amy was asking where can I see this video again. As I just mentioned, go to Home tab and the Tutorials link, and the videos will be here. You can see all of our videos from previous webinars, and also the videos Ross made for different features of the website. Future earnings, as Ross explained, we don't really believe very much about the future earnings forecast, so we don't put effort on it. The Peter Lynch newsletter at this point only covers U.S. stocks, yes, and we focus their high quality growth companies at low prices. They are mostly in small cap area. Yeah, how do we calculate predictability rank? Yes, that's our proprietary calculation. Okay. If there's no more questions, I'll turn this back to Ross. Thank you very much.
All right, well, thank you, Charlie, and thanks everybody for joining us. If you got any last questions, I'll be glad to answer them, covering how to scan for stocks or different features of the website. Again, the Guru Focus website is so complex and so complete that it's kind of taking us several weekly webinars in a row to kind of cover the various aspects of it. But the goal of this is to show you how to better utilize the features, and if you're not a premium member, to really give you an inside look at them to see if it's something that's of value to you as an investor. Oh, Greg, the highlighting tool, that's part of the recording software. It's called Camtasia software, and it's got the tools in it. Emmanuel, the data is uploaded almost immediately after an earnings release. So once it hits Morningstar, it's usually maybe a 20-minute lag before it's on the website. John, how can we use these tools for early stage companies? So John, the biggest thing, when you look at an early stage, there's three stages in a company, right? The first is kind of the proving the process stage, where they are trying to see if they can, they've got one profitable business, okay, and can they replicate that model? So once upon a time, there was only one Taco Bell, and they said, you think we can open another one? You think it's going to work? We do the same thing. So that's the experimental, the initial stage. Then there's the growth phase, and that's what we're all after, right? That's where the big money's made. That's the land of the 10 baggers. That's where stock goes from $3 to $100. That's the big success stories. And then finally, there's the maturity stage, where a company kind of slows down its growth. No one can maintain 20, 30, 50% growth for forever. Anywhere from 3 to 10 years generally is kind of the cap on that. And when that happens, the PE ratio shrinks and the company becomes, the 3M, the IBM, the Johnson & Johnson caliber slow grower. So if you're looking for the growth companies, and the biggest thing I would tell you to scan for, Greg, in looking for these, is fast growth, and you want them off the radar. Okay, once Wall Street owns them, a lot of the opportunity is gone. So I would look for maybe institutional ownership of less than 20%. You want to find growers that are growing at least 20% annually and have done so for at least a couple of years. You're not going to find your Teslas and things like that because it's a company that doesn't even make any money. I would encourage you, if you're looking at a growth stock, no matter how fast it grows, they can still go bankrupt if they carry too much debt, if they're not profitable. Growing sales is not the same as growing earnings. So, I focus on earnings per share growth. You want, maybe 5 years of at least 20%. And then you just want to watch the debt issues. You want to go to the fundamental area, be sure the debt to equity is being maintained low. Maybe give them a little bit more slack since they're a growth company, but no more than 40 or 50%. On the growth side, and then just be sure you're not paying an outrageous amount. You don't want to, even if it's a 30% grower, there are prices that are too high. So, I'd look for a peg less than 1 or less than maybe 1.2 or something to really shrink that number down. Now we've got the whole globe we're looking at here, but if we just switch to the U.S. and if we exclude OTC stocks, we'll get it down to a pretty small list of reasonably valued growers. And those are the ones you really want to dig in, find the stock story, see what's going on with the company, learn about their business model. Is it replicable? Are they continuing to grow? Is it something that is in danger from changing market conditions, or is there a trend changing? Just kind of do your homework. Greg, is MS star rating included anywhere in the platform, or does Guru Focus Predictability replace that? Yeah, no, the Morningstar is not in there, right? The Guru Focus Predictability is in there. Yeah. Gary's, if you're talking about the Peter Lynch portfolio, so stocks are added on a monthly basis. We find the top quality stocks, and we're gonna, it'll be monitored on a monthly basis. So those that reach or exceed value will be removed from the portfolio and updated, and those that present themselves as value will be added in. So it'll be tracked live. Any buys and sells, you'll be advised on, and they'll be all done in a live money account. Greg, yeah, all metrics, all fundamental data exports to Excel and downloaded. Scott, it's just a different offering. I mean, some people prefer to do all of it themselves. Some like a fundamental newsletter that's done a lot of the homework. That's got a couple of analysts following it. If that's your cup of tea, if you like growth stocks, if you like finding high quality growers at reasonable prices because they're kind of harder to find in today's market, it's a product that may be of interest to you. I mean, at $80 a year, stocks don't have to move that much to pay for your subscription, But you're not in any way required to get it, no. All right, well, thank you all again for joining us. We appreciate you being here. If you have topics you'd like covered in the webinar, please feel free to email support@gurufocus.com. We'll be glad to take those in consideration and try to cover all of your topics. And we look forward to working with you going forward. If we can do anything for you, if there's a feature you'd like added to the website, or questions you have, please feel free to email us. We'll be glad to do everything we can to make your experience at Guru Focus the best possible. Thanks again, guys, and have a wonderful night.